If you don't understand the Greeks, you're already losing money with crypto options. I am full-time institutional crypto trader and my public portfolio has 75% of annual return. And by the end of this video, you will learn how to use Greeks for your advantage. So hit that like button and let's go. So first of all, what are the Greeks? So to keep it very simple, Greeks help us to measure how the price of the options could change in the future. And there are only 4 different Greeks, and we will cover what they mean, and also we will take a look at the real-life examples on Deribit, ByBit and also Binance exchange. Some of the Greeks are more important than the others. Depends on the strategy. But to learn the basics, we will cover all of them. And here we go with the first one. So to begin with, it's very important to understand that the option prices are not linear. So it means if the price of Bitcoin moves by $1, option prices will be not changed by $1 as well. And here comes the delta. So delta shows how the option prices will changes for every dollar price change in Bitcoin or in a different cryptocurrency. If the price of Bitcoin changes, let's say by $1, delta shows how the price of the option will be changed as well. And let's take a look at the Bitcoin example. And for all other cryptocurrencies, it works in a similar way. So let's say that the Bitcoin price is at $100,000. The option price is equal to $1,000. The option delta is equal to 0.5. And let's assume now that the Bitcoin price increases by $1. So from $100,000 to $100,001. And as I said, the delta number is the value that the premium price will increase or decrease by. And as a result, because our option delta is 0.5, the option price moves by the same $0.5 and is equal to $1,000.50. And this is how the delta works. And now let's take a look at the real-life example on ByBit exchange. So here we can see the option chain and here we can see the delta. And it's important to notice that the delta has a value between 1 and 0 for a call options and -1 to 0 for put options. So basically delta is always between 0 and 1, but for call options it's a positive value and for puts it's a negative value. And let's take a look at the real example. So here we have almost at the money strike price, which is equal to $115,000. So the strike price is almost equal to the market price of Bitcoin. And the delta is equal to 0.51. And exactly as it was in our previous example, if the price of Bitcoin will increase by $1, the option price will increase by $0.5 as well. If we take a look at the strike price of $125,000, we can see that the delta is equal to 0.21. In this case, if the price of Bitcoin will increase by $1, the price of this option will increase by $0.21. And as you can see, the strike prices that are far away from the current market price are less affected by the price increase of Bitcoin. And as you can see, for example, the strike price of $160,000 has a delta of 0.01. So that means the price increase of Bitcoin by $1 will affect the option price only by 1 cent. And now let's take a look at the Deribit exchange. So here we can see almost the same option chain, but as you know, for the options which are inverse options on Deribit, prices are displayed in the cryptocurrency. So that means if I would like, for example, buy a call option with a strike price of $120,000, I have to pay a premium in Bitcoin. And here you can see the same delta value of 0.35. Delta indicates also the dollar value. And that means if the Bitcoin price will increase by $1, this call option will gain a value of 34 cents. And watch this video until the end, because I will reveal a very critical delta factor that can change how you trade options. And the second important Greek is gamma. So we understood delta and how option prices changes with delta. And now we are ready to understand gamma. Gamma shows the rate of change of the options delta for every $1 move in the cryptocurrency asset price. So simply speaking, gamma shows how fast delta changes. And now let's take a look at the same example, but at gamma. So the price of Bitcoin is still at the $100,000. Option price is equal to the same $1,000. Option delta is 0.5 and gamma for the option is equal to 0.01. So and let's assume that the Bitcoin price increases by $1. So from $100,000 to $100,001. The gamma for the option, which is 0.01, will affect delta. So with $1 price move in Bitcoin, delta will add the value of gamma. So the initial value of delta was equal to 0.5, and after Bitcoin price moved by $1, delta added the value of gamma. So 0.5 plus 0.01 is equal to 0.51. And this is how it works. And now the delta is higher, and that means that when the Bitcoin price will increase by another $1, delta will affect the option price even more. So in this case, if the Bitcoin price will increase by another $1, the option price will increase by $0.51. And that's it. And now let's take a look at the real example on ByBit. So and first of all, to find the gamma, we have to click on the filter button and select gamma. And here we can see the value for gamma. So and this value indicates that if the price of Bitcoin will increase by $1, delta will increase by 0.00003 as well. So and that means if the price of Bitcoin will increase by $1,000, the delta will increase by 0.03 and will be equal to 0.51. And now let's take a look at the gamma on Deribit exchange. And let's take a look for this time the options for Ethereum. To enable gamma, we have to open the columns and select gamma. And here we go. So let's take a call option with a strike price of $4,400. Here we can see the delta, which is equal to 0.42. So a short recap, if the price of Ethereum will increase by $1, the option price will increase by $0.42 as well. And here we can see the gamma. And the gamma is equal to 0.00052. So that means if the price of Ethereum will increase by $1, delta will increase by 0.00052 as well and will be equal to 0.42052. And to keep it simple, we can remember this in the following way. Delta is the speed of the option price change and the gamma is the acceleration of this speed. And now let's take a look at my most favorite Greek, theta. And before I explain you about the theta, there is one important concept that you need to learn about the options. And this is one of the most important things about the options. So all options lose their value as they get closer to expiration date. And the next Greek is my favorite one because it shows exactly how fast the options lose its value if all other things stays unchanged. Theta is also known as the option's time decay. It's a daily amount by which options value drops if all other things stays unchanged. Theta has a negative value, and this number shows how much value the option will lose per day. And now let's take a look at the example. So we have the same option price of $1,000, and let's assume that the theta is minus 70. So that means if everything stays the same, the option will lose $70. And this is the main reason why I love to sell option and not to buy the options. Options have a huge time decay, and the options buyer lose a lot of value just because time passes. And now let's take a look at the real example. And first of all, to find the theta, we have to click one more time on the filter button. So let's disable the gamma and enable the theta. And here we go. So let's take a look at the call option with a strike price of $170,000. And here you can see the theta is equal to $72. So the option price is equal to $3,600 and the theta is equal to $72. So that means the theta indicates that everything stays the same. Tomorrow this option will lose $72. And now let's take a look at theta for long-term options. For example, let's take the call option with a strike price of $140,000. Here you can see that the mark price of the option is equal to $6,525. And theta in this case is equal to $35. So that means in this case, if nothing will change, tomorrow this option premium will decrease by $35 and will be equal to roughly $6,480 tomorrow, if all other factors will stay the same. And now let's take a look at the short-term options. And here we can see the magic. So let's take a look at the strike price of, for example, $116,000. So here we can see that the mark price of this option is equal to $367. Theta in this case is equal to 160. So that means if everything stays the same, tomorrow this option will lose $160 and will be equal to a bit more than $200. And here you can see that this option loses almost half of its value per day if everything stays unchanged. So and that's why this is very important to understand theta before start to trade options. And now let's take a look at the Deribit platform. Let's go back to the Bitcoin options and enable theta on the option chain. So let's disable gamma and enable theta. So and here we go. Now we can see the theta for Bitcoin options. And as it was with the ByBit options, theta indicates that dollar value on Deribit platform. So and that means if we take a look at the call option with a strike price of $120,000, we can see that the mark price for this option is equal to 0.0222 Bitcoin. But as you can remember, theta indicates the dollar value. And for example, if I'm going to sell this option, I will receive the premium of 0.022 Bitcoin, which is roughly the equivalent of $2,510. So and that means if everything stays the same, tomorrow this option will lose $67 of its value and will be equal tomorrow to $2,442. But of course in Bitcoin price, because inverse options on Deribit platform are traded only in Bitcoin prices. And now you can see how selling the options is attractive, because I can simply sell the option and let the theta do its thing. And as option price decreases, I, as a seller of the option, make a profit. And I have full step-by-step guide how to sell call option and also how to sell put option for Deribit platform and also for ByBit platform. So all the links you will find in the description below. And now let's take a look at the last Greek called Vega. So you're doing a great job. Keep watching, because Vega is very important in the cryptocurrency options, because it measures how the volatility affects the option prices. And by the way, this is the last Greek that we need to cover. So you're doing a great job. So once again, what is the Vega? Vega shows how the option price changes with 1% change in implied volatility. If the implied volatility increases, option prices increases as well. And as you can see, this is very important for the cryptocurrency options, because volatility can increases very sharply and this immediately affects the option prices. And also if the implied volatility decreases, option prices decreases as well. So it works in the both directions. So if implied volatility increases, option prices increases as well. And if implied volatility decreases, option prices decreases as well. So it works in the same direction. And as you can see, it's very important to understand what implied volatility is. And I have a great video for beginners what implied volatility is. The link you will find also in the description below. But keep it short, implied volatility is a market forecast of volatility or a price movement in the future. So if implied volatility increases by 1%, the option prices will increases by Vega number. And let's take a look at the example. So we have the same option price of $1,000 And let's assume that the implied volatility is equal to 30% and Vega is equal to 50. So let's assume that implied volatility increases by 1%, so from 30% to 31%, and as a result the option price increases from $1,000 to $1,050. So you get it. You guys are smart. And now let's take a look at the real example. And first of all, we have to enable the Vega. So I'm going to disable Theta and enable Vega. Here we go. So let's take a look at the call option with a strike price of $116,000. So here you can see the market price of this option is equal to $342. And here we can see the Vega for each strike price. And for a strike price of $160,000, Vega is equal to almost $29. So that means if the implied volatility, which is right now is equal to 27.5%, will increase by 1% and will be equal to 28.5%, the market price of the option will increase by $29 and will be equal to more than $370. And as you can see, this is quite feasible, because if implied volatility will increase by 10%, which could easily happen during volatile markets, the option price in this case could increase by almost $300. So that's why this is very important to understand the Vega. And as I promised, one important thing for you, if you are still watching this video, this is the second very important factor of the delta. And it's very important to understand before start trading options. Delta shows the probability of option end up in the money. And for example, if I buy a call option with a strike price of $116,000, the delta of this option is equal to 0.23. So that means I have only 23% that this option will end up in the money at the expiration date. So only 23% that my option will make a profit. But at the same time, if I am a seller of this option, I have the same delta of 0.23. But in this case, I have 76% that the option will not end up in the money and I will get my profit. So buyer has a 24% of probability end up with a profit, and the seller of the same option has a 76% probability of end up with a profit. So, and you can understand who is on the right side of the equation. Don't forget.
Because the house always wins.
And if you would like to learn more about the crypto options, you can watch my next video here or here. See you in the next video. Bye.